Okay, let's unpack this. Financial concepts, especially something like investment appraisal, can sometimes feel like navigating a dense jungle, right?
Definitely.
But today, we're going to eliminate how two significant forces, inflation and taxation, can profoundly impact our understanding of net present value, or NPV. For those less familiar, NPV essentially translates future cash flows into today's dollars, helping us gauge an investment's true worth. It's a crucial tool.
Absolutely crucial.
And frankly, it's an area where errors are common. We're here to make sure you gain some clarity on this.
That's exactly right. Our mission in this deep dive is really to cut through that complexity. We'll explore the two main pathways for investment appraisal, the nominal terms approach and the real terms approach.
Okay.
And then we'll see how taxation, that ever-present factor, affects both. Our goal is to give you the clear, maybe even surprising insights you need to feel truly well-informed when you're evaluating investment decisions.
So let's start with the fundamental challenge inflation throws at us. If you're expecting to receive, say, $100 sometime in the future, what's its actual purchasing power today?
Right.
Because the reality is future cash flows, when inflation's in the picture, have decreasing purchasing power. $1 tomorrow just won't buy what $1 buys today. Simple as that.
Exactly. And to make that concrete, let's imagine inflation is humming along at 5% per year, and you're set to receive $100 at the end of each year for 3 years.
Okay.
In today's purchasing power, that first $100 received in year one would only be worth about $95.20.
Wow, okay.
By year two, that same $100, its value drops further to around $90.70. And by year three, it's down to approximately $86.40. You can really see the erosion over time.
That erosion is crystal clear when you put numbers on it like that. So flipping that around then, how do you actually maintain the purchasing power of that $100 over time?
Good question.
This brings us to the concept of inflated values, right? Sometimes called nominal values.
Precisely. To keep the purchasing power of that $100 steady with 5% inflation, the actual cash amount you'd need to receive has to grow each year.
It has to increase.
Yeah. So that $100 needs to become $105 by the end of year one. Then it needs to be nearly $110.25 by year two and over $115.76 by year three. That's how you counteract that purchasing power erosion, by receiving larger nominal or inflated amounts.
Okay, and here's a really critical distinction we need to make. The difference between general inflation and specific inflation.
Yeah.
They sound similar, but they work differently in practice, don't they?
They really do.
Yeah.
General inflation is, the kind of thing you see published, like the Harmonized Index of Consumer Prices, HISP, in the Eurozone. It's a broad measure.
Like the headline rate?
Exactly. Specific inflation, though, is where things get more granular. It means different parts of your project, maybe the selling price, variable costs, fixed costs, they inflate at their own rates. So maybe your selling price goes up by 5%, but your variable cost only increased by 4%, and perhaps fixed costs jump by 6%.
Yeah.
They don't necessarily all follow that general headline rate.
Gotcha. That makes sense. Okay, let's pivot now to the other side of the NPV coin, the cost of capital. How does this whole inflation picture affect the discount rate we use? Because that rate is absolutely key for figuring out present value.
It's a fundamental link. And the relationship between the real cost of capital, the nominal cost of capital, and general inflation, it's captured perfectly by the Fisher formula.
The Fisher formula, right?
It basically states that 1 plus the nominal cost equals 1 plus the real cost multiplied by 1 plus general inflation.
Okay.
So for example, if your real cost of capital, like your required return above inflation is 4.0% and general inflation is, say, 4.8%. The Fisher formula tells us your nominal cost of capital is 9.0%. 1.04 times 1.048 gives you 1.09. And crucially, since costs of capital are often given in nominal terms already, we usually use the formula to work backwards. So if you're given that 9.0% nominal cost and 4.8% general inflation, you can deflate it. 1 plus 0.090 divided by 1 plus 0.048, that gets you back to 1.04 or a 4% real cost of capital.
Okay, that formula seems pretty powerful for switching between the two. Now, we understand how inflation hits cash flows and the cost of capital. How do we actually craft these cash flows for an investment appraisal? Let's start with nominal cash flows. What are those exactly?
Right. Nominal cash flows are essentially your future cash flows, but they're already adjusted for those specific inflation rates we talked about.
Ah, the specific ones.
Yes. You take your current prices and inflate them into future values using those specific rates. Let's walk through a quick example.
Okay, let's do it.
Imagine a project. Current selling price, $5.30 per unit. Current variable cost, $3.15 per unit. Now, add specific inflation. Selling price inflates at 5% a year, variable cost at 4% a year. And let's say it's a 4-year project, starting with 300,000 units sold in year 1. And that volume increases by 50,000 units each year.
Got it. Volume's growing too.
Exactly. So to get our nominal cash flows, we apply those specific inflation rates year by year, that $5.30 selling price. With 5% inflation, it becomes about $5.57 in year 1.
Okay.
Then $5.84 in year 2, $6.14 in year 3, and roughly $6.44 in year 4.
Right. It keeps climbing.
And you do the same for variable costs with their 4% inflation rate. They go from $3.15 to $3.28 in year 1, up to about $3.69 by year 4. Then you multiply these inflated unit figures by the forecast sales volume for each year. That gives you your total inflated sales revenue and total inflated variable costs.
Okay, so revenue and costs are both growing due to price cost inflation and volume increases.
Precisely. And the difference between that inflated revenue and inflated cost each year, that's your nominal terms total contribution. So for instance, using those numbers, year 1 nominal contribution might be around $687,000. Year 2, maybe $850,500. Year 3, $1,040,000. And year 4, about $12,237,500. These are your nominal cash flows before things like fixed cost or tax.
Okay, so we've built up these nominal cash flows using the specific inflation rates. But to really understand the underlying purchasing power, we need real cash flows. How do we get those?
Good question. Real cash flows are what you get when you take those nominal cash flows we just calculated and you deflate them using the general rate of inflation. Let's stick with our 4.8% general inflation rate from before.
Okay.
So take that year 1 nominal contribution of $687,000, divide it by 1 plus 0.048. That gives you about $655,534 in real terms in today's purchasing power, essentially.
Right, stripping out that general inflation effect.
Exactly. And you do that for each year. That year 4 nominal contribution of over $1.2 million, when you deflate it back using the 4.8% general rate over 4 years, it comes down to roughly $1,025,888 in real terms.
So this gives you the true inflation-adjusted value, the real purchasing power of those future contributions.
That's the idea. You've removed the effect of general price level changes.
Perfect. Okay, now let's bring this all together. We have nominal cash flows, real cash flows, nominal cost of capital, real cost of capital. How do these actually get used in an investment appraisal to calculate our net present value?
Right. This is where we see the two paths converge. There are 2 main ways to calculate the NPV, and they should theoretically give you the same answer.
Okay, path 1.
Path 1 is the nominal terms approach. This is usually the more direct route if you have specific inflation rates. You take your nominal cash flows, the ones we calculated using specific inflation.
The $687,000, $850,500, et cetera.
Exactly. And you discount them using the nominal cost of capital. We figured that out earlier using Fisher's formula. It was 9.0% in our example.
9.0%.
So you discount each of those nominal contributions back to the present using that 9.0% rate. Let's assume our initial investment for this project is $1 million at time 0.
Okay.
If you run the numbers, discounting those 4 years of nominal contributions at 9% gives you a total present value of about $3,025,871. Subtract the initial $1 million investment, and you get a nominal NPV of approximately $2,025,871.
Okay, a positive NPV, so it looks like a good investment based on this method. Now, what about the other path, the real terms approach?
Path 2 is the real terms approach. Here, you take your real cash flows. Remember, those were the nominal ones deflated by the general inflation rate, 4.8% in our case.
The $655,534 for year 1 and so on.
Yep, those ones, and you discount these using the real cost of capital. We also calculated that earlier it was 4.0%.
Right, 4.0%.
So you discount those real contributions back to the present using the 4.0% real rate. Again, assume the same $1 million initial investment. Discounting those 4 real cash flows of 4.0% gives a total present value of about $3,026,455. Subtract the $1 million investment, and you end up with a real NPV of approximately $2,026,455.
Okay, wait a second. Let me compare those 2 numbers. $2,025,871 from the nominal approach and $2,026,455 from the real approach. They're basically identical, just a tiny rounding difference. difference.
Exactly. And that's the crucial insight here. This is the aha moment, allowing for those minor rounding differences that creep in with calculations. The nominal NPV and the real NPV are the same.
Wow.
It means both methods, when you apply them correctly, matching nominal flows with nominal rates and real flows with real rates, lead you to the exact same investment decision.
That's actually quite powerful. It removes a layer of worry about picking the right method in terms of the outcome.
It does. One isn't inherently better than the other for the final decision signal. It often comes down to what data you have and sometimes what's easier to calculate or explain.
That brings up a good point. Does this sameness correct any common misconceptions? Like, do people often think one method is inherently more correct?
Oh, absolutely. Sometimes people think, well, there's inflation, so I must use the real terms approach to see the true value.
Right.
Or they might see nominal figures as somehow less accurate because they include inflation. But this shows both are equally valid ways to model the financial reality as long as you're consistent.
And in terms of explaining it, maybe nominal feels more intuitive sometimes, like the actual dollars flowing.
That can be true. Nominal cash flows represent the actual amount of money changing hands at that future point in time. Real cash flows require that extra conceptual step of thinking about constant purchasing power. So depending on your audience, the nominal approach might sometimes be easier to communicate, even though the underlying maths gives the same result.
Okay, this is making a lot more sense now.
Yeah.
But what happens when we introduce everyone's favorite topic, taxation? That usually throws a wrench in the works, doesn't it?
It certainly adds another layer, yes. Let's introduce tax into our example. Suppose there's a 25% corporation tax rate.
Okay, 25%.
And let's assume the tax authority allows straight-line depreciation on our $1 million initial investment over the 4 years of the project with zero residual value. We'll call this tax-allowable depreciation, or TAD.
Right, so the annual TAD would just be $1 million divided by 4 years.
Exactly, $250,000 per year.
And that depreciation isn't a cash flow itself, but it reduces our taxable profit, right? So it creates a tax benefit.
Precisely, it creates a tax shield. The annual tax benefit or tax saving from this depreciation is the TAD amount times the tax rate.
Yeah.
So $250,000 times 25%.
Which is $62,500 per year.
Correct. A $62,500 cash inflow effectively due to lower tax payments each year.
Okay, so how does this fit into our NPV calculations? Let's start with the nominal terms NPV again, but this time with tax. And let's assume tax is paid in the same year it's incurred, no deferral for now.
All right, so we take our nominal contribution for each year, that $687,000 in year one, for example. We calculate the tax on that contribution, $687,000 times 25%. That's the tax payable.
Right.
Then we add back the tax saved due to the depreciation shield, which is that $62,500 we just calculated.
So it's nominal contribution minus tax on contribution plus tax saved from depreciation.
You got it. So for year one, $687,000 minus $687,000 by 0.25 plus $62,500. That gives us a nominal after-tax cash flow for year one of about $577,750.
Okay, and we'd repeat that calculation for years 2, 3, and 4 using their respective nominal contributions.
Exactly. Doing that gives us the following nominal after-tax cash flows. Year one, $577,750. Year two, $700,375. Year three, $842,500. And year four, $990,625 tavel.
A common way to approximate this is to take the nominal pre-tax cost of capital, which was 9.0%, and multiply it by 1 minus the tax rate.
So 9.0% times 1.25.
Correct, which is 9.0% times 0.75, giving us approximately 6.75%.
Okay, 6.75% is our nominal after-tax discount rate. Yep. So now we discount those four nominal after-tax cash flows, $577,750, $700,375, etc., back to the present using this 6.75% rate. Subtracting the initial $1 million investment, the result is a nominal NPV after tax, not deferred, of approximately $1,611,243.
Okay, still positive, but lower than the pre-tax version, which makes sense. Now let's do the real terms approach, again with tax not deferred. What's the process here?
Same principle. First, we need the real after-tax cash flows. We take those nominal after-tax cash flows we just calculated, $507,750 in year one, et cetera, and deflate them using our general inflation rate of 4.8%. So for year one, it's $577,750 divided by 1.048, which equals about $551,288.
Got it. And repeat for all 4 years.
Yes. That gives us real after-tax cash flows of year one, $551,289. Okay, now we need the real after-tax discount rate. How do we find that?
We use the Fisher formula again. We have the nominal after-tax rate, 6.75%, and the general inflation rate, 4.8%. So we calculate 1 plus nominal after tax rate divided by 1 plus general inflation rate. That's 1.0675, 1.048. Let's see, that comes out to about 1.0186.
Exactly, which means our real after-tax cost of capital is approximately 1.86%, quite low, reflecting that much of the nominal return is just keeping up with inflation and tax.
Right, so now we discount those real after-tax cash flows, $551,288, et cetera, using this 1.86% real after-tax rate.
Precisely. Discount those 4 real cash flows at 1.86%, sum them up, and subtract the initial $1 million investment in the result. A real NPV, after tax, not deferred, of approximately $1,611,289.
Okay, let me check again. Nominal NPV was $1,611,243. Wow. It holds true again. They are effectively identical, just tiny rounding differences.
See, the consistency is remarkable, even when we add the complexity of tax. So long as we treat everything consistently within each approach, nominal flows with nominal after-tax rates, real flows with real after-tax rates, we arrive at the same investment conclusion.
That's really reassuring. Okay, but what if tax isn't paid in the same year? What if it's deferred, say, paid 1 year in arrears? That must change things, right? It changes the timing and the cash flows.
It absolutely changes the timing, and therefore the NPV. Let's look at the nominal terms approach with tax deferred by 1 year.
Okay.
The pre-tax nominal contributions are the same, $687,000 in year 1, etc. The tax calculation itself is the same, but the payment happens a year later, and the tax shield from depreciation also happens a year later.
Okay, so year 1's cash flow is just the pre-tax contribution because the tax effect hits in year 2.
Exactly. So year 1 nominal cash flow is $687,000. For year 2, it's the year 2 nominal contribution, $850,500, minus the tax on year 1's contribution, plus the tax shield related to year 1's depreciation. That works out to about $741,250.
I see the lag effect now.
Right. Following that pattern, year 3 cash flow is about $889,875. Year 4 is about $1,040,000. But crucially, we have tax related to year 4 profits and depreciation that isn't paid until year 5. So we have a cash flow in year 5.
A negative one, just the tax payment.
Yes. A negative cash flow in year 5 representing the tax on year 4's contribution, offset slightly by the final year's tax shield. It comes out to about $246,875 in year 5.
Okay, so a 5-year cash flow profile now. And the discount rate, still the nominal after-tax rate.
Yes, the nominal after-tax cost of capital remains 6.75%. We discount this new 5-year pattern of nominal cash flows, 687Ks, 741K, 890K, 140Ks, netting to 247K at 6.75%. Subtracting the $1 million initial investment gives a nominal NPV, after tax deferred, of approximately $1,648,333.
Interesting. Slightly higher than when tax wasn't deferred. That delay helps the NPV.
Generally, yes. Delaying tax payments tends to improve the NPV.
Okay, last calculation then. Real terms NTV with tax deferred. We take those nominal cash flows we just figured out.
The 5-year stream, including the negative year 5 flow.
And deflate them all using the 4.8% general inflation rate.
Correct. So year 1 nominal 687K becomes $655,534 real. Year 2 nominal 741K becomes $674,944 real, and so on. That year 5 nominal outflow of 1 given $247K becomes about negative $195,286% in real terms when deflated over 5 years.
And the discount rate is still our real after-tax rate of 1.86%.
Yes, that hasn't changed. So we discount this 5-year stream of real after-tax cash flows using the 1.86% real rate. Subtract the initial investment, and we get a real NPV after-tax deferred of approximately $1,648,376 true.
Let me check again. Nominal deferred was $1,648,333. Real deferred is $1,648,376. It's uncanny. They match perfectly, allowing for rounding. Yet again.
It really drives the point home, doesn't it? Even with the added complexity of deferred taxation altering the timing significantly, the fundamental principle holds. Nominal approach and real approach done correctly and consistently yield the same NPV.
That is absolutely fascinating. Okay, so given this consistent outcome, how do you actually decide which approach to use in practice? When does it make sense to choose one over the other?
That's the practical payoff, isn't it? Here's the guidance. Look at the information you're given. If a situation gives you specific inflation rates for your project variables, like selling price, costs, but it doesn't give you a general rate of inflation, then you have to use the nominal terms approach. You simply don't have the general inflation rate needed to calculate real cash flows or a real discount rate.
Okay, that makes sense. No choice there.
Right. Now, what if you were given both specific inflation rates and a general rate of inflation?
Which seems common in textbook examples, maybe less so in reality sometimes.
Perhaps. But If you have both, the nominal terms approach is actually quicker and usually recommended.
Quicker? Why?
Think about the steps. To do the real terms approach, you first have to calculate the nominal cash flows using the specific inflation rates anyway.
Right, we did that first.
Then you have to do the extra step of deflating those nominal flows using the general inflation rate to get real flows. And you also have to calculate the real discount rate using Fisher. With the nominal approach, once you have the nominal flows, you just need the nominal discount rate, which might be given or calculated via Fisher from a real rate, and you discount directly. Fewer steps.
Ah, I see. So since you have to calculate nominal flows anyway for the real method, you might as well just stick with nominal if you can.
Pretty much. Why do the extra work of deflating everything if the nominal route gets you to the same answer more directly? Unless, of course.
Unless what?
Unless a particular scenario or exam question specifically tells you to use the real terms approach, or perhaps even asks you to demonstrate both.
Right. Always follow instructions. But as a default, if you have all the info, nominal is often more efficient.
Exactly. The key pitfall to avoid, though, is mixing them up.
Like using nominal cash flows with a real discount rate.
Yes, or real cash flows with a nominal rate.
Yeah.
That will definitely give you the wrong answer. Consistency is paramount within whichever method you choose.
Got it. Nominal flows, nominal rate, real flows, real rate. Keep them paired.
That's the golden rule. So to kind of wrap up this deep dive, the core takeaway is really clear, I think. Whether you navigate this using nominal terms or real terms, and whether you factor in taxation immediately or with a delay, both approaches, when you apply them correctly, consistently lead to the same net present value. The key to getting it right isn't about picking a better method in some absolute sense. It's about understanding the definitions, what nominal and real mean for both cash flows and rates, understanding the Fisher formula that links them, and then meticulously applying the correct rates to the correct cash flows based on the specific information you have.
That really provides the clarity, doesn't it? It moves beyond just knowing the formulas to understanding the why behind them and the relationship between the approaches. It's not about stressing over which method is inherently superior, but about knowing which one fits the data you've got or which one is more efficient, and then feeling confident that your valuation holds true regardless.
Exactly. Confidence in your chosen method and its result.
So maybe a final thought for you listening. How might understanding this interplay, this equivalence between nominal and real values, not just in complex business investments, but perhaps in your own personal financial planning, your savings, your retirement goals, how might that change the way you think about and plan for your own financial future? Something to ponder.